There are three types of profit margin: gross profit margin, operating profit margin, and net profit margin. In this video, I'm going to tell you what they are, how they're calculated, and why they're very important if you're trying to run a successful business. And by the way, I'm Kyle, you're watching Solid Strat. This is a channel dedicated to teaching solid strategies for content creation, business development, and building a lifestyle that you own. All right, so gross profit margin tells you how profitable your business is at the product level before you factor in additional costs of running your business like rent and salaries and so on. Here's the formula. It looks kind of complicated, but it's actually very easy to solve. In fact, let me just show you how easy it is by calculating the gross profit margin for a business that sells this. It's a whiskey spice kit. And after that, we will calculate the operating and the net profit for the same business. I already know the cost of goods for this item because I used our solid margin calculator to figure it out. I've done several detailed videos on that, which you can find in the description. You can also download the sheet itself, which is in the description too. Anyway, we'll assume that this is the only product the company sells and that they sold 5,000 units at $20 a piece last year for a total annual revenue of $100,000. Referring back to that original formula, it's going to be the $100,000 minus the cost of goods sold, which is $60,000, divided by the revenue, which is $100,000, times 100, because this is a percentage. And what we end up with is 40%. So at a 40% gross profit margin, that means for every dollar of product you sell, you keep 40 cents. Or for every $100,000 of product you sell, you keep $40,000. And I'd argue that this number should be no lower than 40%, especially if you're a small business, you're just starting out, and you're selling direct to consumer. Some businesses can get away with a lower profit margin, say like 30%, but that type of a business would need to be doing a very high volume with low overhead. The reason you're more likely going to want to shoot for a 40 to even 50% margin if you're an online retailer selling direct to consumer is that this gross profit margin calculation doesn't include all of the cost of running a business. Those additional expenses are factored into the operating profit margin, which we're going to talk about now. Operating profit margin tells you how profitable your business is at an operational standpoint, and it accounts for the day-to-day costs of actually running the business, not just making the product. So we're talking stuff like rent, utilities, software subscriptions, website hosting, salaries for yourself and other higher level employees not directly involved in making the product, insurance, bookkeeping, your CPA, anything else you need to keep the business running. And the formula for that is gross profit minus operating expenses divided by revenue times 100. So in this example, let's just say our operating expenses are $30,000. You've bootstrapped the thing, so your expenses aren't that high, but you've paid yourself a little bit of money. Also had to pay for some other stuff, which totaled $30,000. So we're going to take our gross profit, which is $40,000, minus our operating expenses of $30,000, which leaves us with $10,000, divided by our total revenue, which was the $100,000, times 100, because again, we're looking for a percent. And what we end up with is an operating margin of 10%. This number gives you a clearer picture of how healthy your business is once real world costs are included. It tells you how efficiently your business is running at an operational level. If you have a gross profit margin of 40%, right, which is pretty healthy, and you have a low operating margin or no operating margin, that means your products are priced well, but you're not running your business very efficiently. You're spending too much money on other stuff beyond that product. So you either need to increase your volume, increase your margin, or reduce your operating expenses. In this case, though, we have $10,000 in operating profit, which isn't bad for a business that only did $100,000 in sales. Though we're not done yet, there are more expenses that we have to consider, and that's what we'll look at to calculate the net profit margin. So net level expenses, which I just have included in this spreadsheet as other expenses, include stuff like interest on any loans you have, the taxes that you're going to have to pay on any profit that you've made, any one-time setup fees, or any other one-time fees. Say you've bootstrapped this thing, but you're operating your garage, which didn't have any overhead lights to start with. You're not going to have to put in overhead lights every year. You're going to have to do that one time. And that one-time expense is going to be included in the net level expenses or the other expenses cell here in our spreadsheet. All right, here is the net profit margin formula. It's simply the net income divided by the revenue. So it's the annual revenue minus the cost of goods sold minus the operating expenses minus other expenses. And for us, that number works out to be $7,000. So we take this $7,000, we divide it by the revenue of $100,000, which gives us a net margin of 7%. This is the bottom line, what you're left with after you subtract all of your expenses. Like I said in other videos, I'm an entrepreneur. I've been running my own business for 15 years, and I have been using a spreadsheet just like this since day one to make sure my margins are healthy at all levels of business, and give this sheet a lot of credit for the fact that my business has grown like it has over the years. You can download a copy on our website, solidstrat.co. Thank you for watching. If you found this content useful, please hit the like button and consider subscribing to our channel. I'll see you on the next one. Thanks.